Hello, everyone. Welcome to a discussion of An Intelligent Investor. We're just going to go through some of our highlights for those of you who have read the book and want to hear our favorite takeaways, or those of you who are just watching this to get a high-level summary of maybe the most key important concepts that you would get if you did read the book. So we have three people that are going to share first, and then I'm going to close, turning it over to Andrew if you want to briefly introduce yourself and then give a little summary of your highlights from the book.
Thank you. Hi, I'm Andrew. I have the privilege of being Elizabeth's older brother, and I also have a job working in finance at a hedge fund. Apologies if I'm stealing other people's highlights as well, but I think two of my favorite concepts are the idea of evaluating stocks not as numbers on a page or lines and squiggles on a chart, but as businesses with a past, a future, an uncertain future, because we can't forecast perfectly, but with a business plan and some way of trying to make money, create value for shareholders, for customers, for all constituents. So evaluating stocks as companies rather than as merely a piece of paper. And then also being independent of the whims of the market. We talk about the goal is to buy low and sell high. Sometimes everyone is right and things are cheap and it's a good time to buy. But if everyone thinks they're cheap, generally people have bought. And so that is not always the best time. Instead, we should do the analysis for ourselves, try and again evaluate it as a company and decide, is this an attractive offer for a business rather than just being persuaded by the manias that Benjamin Graham personifies with Mr. Market.
I'll go next. I'm Connor. I've written a few articles on the finance project, and it's a thing that me and Beely created to help friends and our friends learn about finance, because we feel that we worked at a finance company, we have a good understanding of these things, and Intelligent Investor is a great book it was a great book for me to really walk the walk and learn what I feel like I needed to learn in terms of the investments in the market. My big takeaway from the book is people like to think about investing in a company and its stock price on past performance. And that's really dangerous for two reasons. Past growth has now been priced into that price. And so people make that stock more expensive because of its past growth. And that doesn't necessarily show future growth. I think that this means that a future investment based solely on the historical performance doesn't make any sense. And I think he really does a good job of explaining that. And my second thing that I take away from this book is that it's really good at predicting the future. So whether it be a tulip bulb explosion in, I think, the 1600s or even before that, or GameStop today, I think that this book has lessons that are timeless and makes the book a classic.
My name's Paul. I've been in finance or working in finance for a quarter century or so. What I really enjoyed about this book is that it's actually a very basic and timeless idea, not just so much buy low, sell high, but how our human tendencies and behaviors, which is very slow to change over time, can get in the way of our own best interests. And it's a message that was true in the 60s, got true in the 70s, 80s, and all the way to now, to the 2020s. And it'll be true when we're talking to our grandkids. And it was true for our grandparents. None of this is new. So what I really liked is that there's a lot of discussion about it in the book from multiple points of view, whether it's a technical point of view or social point of view. And I think we tend to forget the power drive of the social aspect of our nature and how that can affect us in our finances. So I think the book did a great job of that.
Awesome. I have two highlights, one of which is this book helped me to understand how to view the market in a sensible manner. And it does so by breaking down the castle in the air theory and the firm foundation theory. And the castle in the air theory basically says that this pen could be valued at whatever amount people are willing to pay for it. And there's some truth to that. If people are, you see that in real estate all the time, people spending hundreds of thousands of dollars over asking price for a property just because there's a low supply right now and they just want to get a house. And there's another theory, this firm foundation, and that is this pen has an intrinsic value. It's maybe worth $1 if it's really nice, or maybe like 25 cents if it's just a regular pencil. And so that framework really helped me understand that if you are thinking from an intelligent investor perspective, you must operate from the firm foundation perspective, where something has intrinsic value and you're kind of a detective trying to figure out what that is. If you're a speculator, you are basically saying, I think that this could be worth as much as people are willing to pay for it. So I'm going to try and guess what other people are thinking. And it's a way more complicated game and it provides a lot more risk. But that just helped me to understand when I think about investing myself, what lens am I going to view the market through and how am I going to make investing decisions based upon that lens? The second highlight from this book for me was just understanding the different type of investors. We've talked about speculators, value investors, what does the range fall into? And I like to break this down into like 4 kind of groups. One is Mr. Market, and that's just the person that is like, every day you're just kind of manic, you're thinking about things that are happening and you're trying to predict their value in the future, and you have a lot of emotional pulls depending on what the market says that day. The second is the person that's watching Mr. Market. And so they're like also in that boat, but they're not as invested. And then you have these other 2 that are under the intelligent investor umbrella. One of which is maybe a lay value investor where they have just bought index fund as they have a low operating cost and you're just gonna put your money in there, let it go and just kind of watch it. And the other group is still in the intelligent investor group, but they're value investing, where that means that they're looking at the underlying business and they're doing more analysis and they're willing to take more of the microscope to a company than the lay intelligent investor who's just putting their money in an index fund, which is where I tend to lean on the investing spectrum. So it was really helpful for me just as someone who is new to finance, understanding that that is a very viable, good option for me to put my money into a good asset that would have a high ROI without having to risk a lot and be worried by what Mr. Market tells me every day. So thanks again for listening and watching. And if you read the book, let us know your thoughts. Hopefully this was insightful for you. Take care.